Ram Trucks enters 2026 under mounting structural pressure that cannot be dismissed as cyclical weakness. The brand, long dependent on North American full-size pickup demand, now faces a convergence of debt burden, capital misallocation, shrinking unit volumes, and tightening liquidity at its parent company Stellantis. While the broader automotive sector is wrestling with electrification costs and margin compression, Ram's exposure to large combustion pickups magnifies its vulnerability. The first stress factor is mounting debt and refinancing pressure at the group level. Stellantis has carried significant industrial net debt following aggressive electrification commitments and platform investments. Billions have been earmarked for electric vehicle architectures, battery plants, and software ecosystems. Yet pickup truck electrification remains capital-intensive, with uncertain demand elasticity. Delays and recalibrations of electric truck programs suggest projected returns failed to justify continued cash burn. When capital expenditures outrun organic free cash flow, debt absorbs the gap. As interest rates remain structurally higher than in the previous decade, refinancing becomes materially more expensive. For Ram, whose profits historically subsidized weaker divisions, this is an operational constraint. Ram's earnings base is highly concentrated in the Ram 1500 and heavy-duty variants. Such concentration is dangerous when average transaction prices plateau and incentive spending rises. Dealer inventory has shifted from scarcity during supply disruptions to periodic overhang. Incentives protect volume, but they erode net contribution. When residual values decline due to oversupply, lease economics deteriorate, constricting future demand. The second stress factor is collapsing infrastructure and operational decay. Dealer networks are the lifeblood of a truck brand. Reports of strained dealer profitability, slower showroom traffic, and rising floor plan financing costs suggest fragility. Dealers depend on rapid inventory turnover. When trucks sit unsold, interest expenses accumulate. As floor plan rates have climbed, carrying high manufacturer-suggested retail price trucks becomes punitive. Dealers then pressure the manufacturer for additional incentives. Or they reduce orders, squeezing manufacturing efficiency. Supplier stability also deserves scrutiny. The global supplier base has been weakened by semiconductor shortages, commodity spikes, and uneven production schedules. If a key supplier demands advance payments or higher pricing to offset its own distress, Ram's cost structure inflates further. One supplier failure can idle an entire plant, creating negative operating leverage. Fixed costs remain while output falls. Electrification strategy compounds the capital strain. Ram has committed to electric pickups, but the segment remains unproven at scale. Electric trucks require large battery packs, which makes them expensive and heavy. If adoption lags projections, inventory risk intensifies. Battery supply agreements lock in fixed costs that may not be matched by volume. Failed capital allocation into underperforming electric vehicle programs directly damages return on invested capital. Regulatory pressure is tightening across major markets. Emission standards in key markets are becoming more stringent. Compliance costs are rising for brands that rely on large internal combustion engines. Accelerating electrification increases the risk of cash burn on slow-selling models. Delaying action risks penalties and reputational erosion. The dilemma is expensive either way. Unit sales trends amplify the concern. While headline figures may appear stable, the composition reveals vulnerability. Higher trim models historically delivered margin strength. As consumer credit conditions tighten and auto loan delinquencies rise, buyers shift toward lower trims or delay purchases. Pickup trucks are often financed over extended terms. Elevated interest rates increase monthly payments significantly, heightening demand sensitivity. Ram's core customer base, including contractors and small business owners, is particularly exposed to credit constraints and economic slowdowns. Used truck values play a decisive role. Residuals surge during supply-constrained years, but they have normalized. Falling used prices harm lease competitiveness and damage brand perception. When consumers observe rapid depreciation, purchase hesitation increases. Lower residuals also raise leasing costs, undermining new truck turnover. Program cancellations and cost-cutting measures act as visible red flags. Workforce reductions, delayed refreshes, and rationalization of trim levels may improve short-term cash flow, but they signal retrenchment. If development cycles slow, product competitiveness erodes in an unforgiving segment. Please subscribe to our channel. We want to hit 1,000 subscribers this week. The third stress factor is bankruptcy, or forced acquisition risk under adverse scenarios. Stellantis is diversified, but diversification does not eliminate systemic risk. If multiple brands underperform simultaneously, internal cross-subsidization weakens. In a severe downturn, management may prioritize markets or brands with stronger global growth potential, leaving RAM exposed to rationalization. Credit rating downgrades would elevate risk sharply. Lower ratings increase borrowing costs and can trigger covenant pressures. Suppliers may tighten payment terms. Dealers may reduce forward orders. The financial ecosystem becomes defensive. In extreme scenarios, asset sales or joint ventures become tools to generate liquidity. Consumer perception of long-term viability is critical. Automotive purchases represent multi-year commitments. If buyers question parts availability, warranty support, or resale stability, hesitation follows. Perception can shift faster than balance sheets. Once confidence erodes, reversing it requires substantial marketing spend and product excellence, both costly under stress. RAM's exposure to cyclical construction and industrial activity intensifies risk. A slowdown in housing starts or commercial construction directly reduces pickup demand. Revenue concentration in North America magnifies downturn impact. Operational resilience depends on scale and utilization. If plant utilization rates fall below optimal thresholds, fixed cost absorption deteriorates rapidly. Idle capacity becomes a silent drain. Restarting shuttered facilities is expensive. Workforce morale declines when shifts are cut. Skilled labor attrition can create future bottlenecks even if demand recovers. In summary, RAM's downward trajectory is defined by cumulative pressure points: elevated debt at the parent level, heavy electric vehicle capital expenditure with uncertain return, rising financing costs for consumers and dealers, residual value erosion, supplier fragility, and concentration risk in a cyclical segment. Together, they form a structurally fragile equilibrium heading into 2026. Consumer Red Alert. For consumers, RAM's financial trajectory carries tangible consequences. Warranty security, resale value stability, service network continuity, and parts availability all depend on brand health. If liquidity tightens, cost containment often manifests in subtle quality compromises. Supplier substitutions or deferred upgrades may surface later as reliability concerns. Repair frequency directly impacts ownership cost. Dealer network contraction is another risk. If marginal dealerships close due to poor profitability, geographic coverage shrinks. Longer travel distances for service increase inconvenience and cost, especially for commercial users. Resale values warrant attention. Buyers entering multi-year financing assume a certain depreciation curve. If market confidence weakens, used prices can decline faster than projected, increasing negative equity risk. Fleet buyers must evaluate counterparty risk explicitly. Large contracts depend on long-term part supply and consistent production. If supplier relationships deteriorate or output becomes inconsistent, fleet uptime suffers. Prudent consumers should cross-shop competitors, scrutinize financing terms carefully, and prioritize total cost of ownership over headline incentives. Current owners should maintain meticulous service records to protect resale value in uncertain markets. Elevated risk does not equal immediate collapse. It does demand vigilance. Survival may come through restructuring, asset sales, or strategic partnerships that alter the economic foundation of the brand. Please subscribe to our channel. We want to hit 1,000 subscribers this week.